It's officially afternoon, so I can say good afternoon and welcome to the NIH seminar series. Today we have Rebecca Schreiber joining us. She is an independent financial planning and she has financial planning and education background, and her company is called Solid Ground, which I thought was fabulous. Rebecca comes to us. She used to be a federal employee, so she'll be able to speak to some of the financial planning issues related to federal employee benefit programs today. And without further ado, I'd like to introduce again Rebecca to talk to us today about managing your money through life events.
Thank you. Thank you. Again, my name is Rebecca, and I'm excited to be here today to explore the opportunities on how to stay on track financially when life events happen, hopefully ones that are planned or ones that are unplanned, and how to make the most of them. Excuse me for the mic. So, managing your money through life events. The direction that we're going to take today is first describe maybe a healthy place to start. For anyone, can you hear me in the back? For anyone who has been trying to organize their finances or have never tried before, or people who are starting from scratch for some reason or another, that this will give you the opportunity to see, how to sort of build a solid foundation, and then when things happen, things change, how to get back to that healthy place. So creating financial wellness. Financial wellness is the result of vision, drive, and action. It's not just wanting to be somewhere, but making changes to get there. And the role of honesty is really important as well. Honesty is crucial when it comes to creating sort of healthy finances. And a lot of people think that when it comes to determining the difference between their wants and their needs, that a lot of people run into trouble because they take a lot of things that they think are just wants and call them needs. When actually, it's really important to understand what your expected lifestyle is. We actually all have an idea of what a comfortable lifestyle is, whether our personal finances can meet that expectation. But we all have a sense of what comfort is. And it's important to recognize what that expectation is so that you can adjust it if necessary. And a lot of people actually get themselves into trouble because they're trying so hard to cut back on a lot of things. And a lot of these things they actually need. And there are just less expensive ways to go about them. But for example, if you cut out all of the fun in your life, or if you cut out all of the little flexibilities, it's not exactly a sustainable plan. It happens a lot of people cut out all the good things that they're enjoying in their life, are unhappy then, and then come back to it full force again. So recognizing the wants, the needs, and those, every so often, those crucial little luxuries, and the key is to keep them small. They keep us going and help us cope with our stress. And the three dimensions of financial wellness are credit management, budgeting, and investing. And these three topics sort of cover the entire timeline of the financial decisions that we make on a day-to-day basis. The debt management addresses decisions you made in the past that you have to deal with today. Budgeting relates to the spending decisions that you make every day, the ones that actually you have the most control over. And investing is about creating choices for yourself in the future. Please feel free to ask questions at any time. The foundation of strength. Now, many people believe that to create a solid financial foundation, it needs to be complicated. And the truth is that it needs to be sustainable. And for a lot of people who are busy, who have busy lives and a lot going on, simple works just as well. It can be strong and stable and simple, and it's sustainable in the long term. And I call them the 4 accounts that do it all, because these 4 accounts, the checking, savings or a money market account, your traditional or Roth IRA, and your employer-sponsored retirement account, cover just about every plan or every financial goal that you might have, that you might want to save for. So for example, and it's important to have accounts that sort of address the timeline of these questions. So for example, a checking account, obviously direct deposit where your paycheck goes. And any monies that you expect to spend in the near term, the next 3 to 6 months, that's a good place for them to go. For maybe tax refunds that you expect to spend. Should go straight into your checking account if you have the IRS directly deposit it into your checking account. Savings or money market accounts are an excellent place for emergency funds. And that's because the nature of emergency funds is that they're unpredictable. And when something happens, either something good, a great opportunity to maybe enroll in a class or to take a trip, or an emergency, you want that money available to you at any time, which means that it has to be liquid, which means it needs to be in cash. So some people will take their emergency funds and say, well, it's a small fund, and I want to have more money in my emergency fund, so I'll invest it. And then we have a down year in the market, and suddenly that emergency fund that was small to begin with is even smaller now. So making sure that your emergency funds are in cash, preferably in like a money market account or a high yield savings account, so that the money that it feels like is just sitting there is actually earning interest for you. And it's providing peace of mind that if there is some sort of emergency, that you can meet it with your own cash instead of having to rely on credit. The traditional and or Roth IRA, a lot of people find that they have, whether they've rolled them over from previous employers, or they've started a Roth IRA maybe to balance the pre-tax savings that they have in a 401k or a 403b or the TSP program. And each of these accounts sort of gives you a destination for any savings that you may have. Money tends to disappear. If it doesn't have a destination, it just burns a hole in our pockets and we just spend it. So based on your short or long-term goals, the question is, where should this money go? If it's needed for the very short term, the checking, if you're trying to build up an emergency fund, think about a savings or a money market account. And there are several FDIC-insured banks that offer accounts via the web, like HSBC Direct or ING Direct, where you can open these accounts without actually having to walk into their banks, which exist, just not nearby. A traditional or Roth IRA for the long term for retirement dollars. And the employer-sponsored retirement account, whether it's TSP or an old 401k, also for the long term. Something also to be aware of with the Roth IRA is that if there is, it offers an extra level of protection with emergencies. And the reason for that is, let's say something happens and it's big, and you burn through your emergency fund that's in your money market account. With a Roth IRA, the funds that you put into it were after tax, which means that you paid taxes on the money, and then you put it into the Roth IRA. And the way Roth IRAs work is that any contributions that you make to the plan, you can take out at any time without taxes or penalties, because you've already paid taxes on it. And if you find that you've burned through your emergency fund and you have a choice, you can either pull, if you need to, your contributions only from the Roth IRA, or if you find that you need to turn to your credit cards, that's an option too. Although at least you have options, knowing that if you need to, you can pull your contributions from the Roth IRA. So that can sort of be a second safety net. I don't recommend it, but it is there.
Is there an income restriction for the Roth IRA?
There are. I don't have them right in front of me at the moment, but I remember I've recently checked on it for a married client, and that I believe that was around the 150s to 160s in terms of adjusted gross income for the household. For individuals, I would have to check. I believe it's around 100 or 110, and that's adjusted gross income. But I would definitely recommend going to the IRS website for that. You just Google in income restrictions for a Roth IRA, and you'll be able to find them. Another part of creating that strong foundation of personal finances so that you can come back to it, sort of that destination, that place you want to be when something happens, is also certain identity theft precautions that you can take, good habits to get into. So, for example, the separate checking accounts and credit cards is something that is very helpful for someone who manages their finances with someone else, maybe a spouse or a partner, or just someone that you share expenses with. And the benefit of that is that if all of your accounts, credit card accounts, checking accounts, are joint, and one person is the victim of identity theft, then it can hurt the other person's score as well, because both names are on that account, and both names could be hit. So in that case, it's very helpful to have that joint account if it's working for you, but also at all times to maintain a separate, that each person should maintain a separate checking account and credit card, just so that if there is identity theft on the joint account, then there will be accounts that you can use that are untouched to receive your paychecks. If you normally use your credit cards on a regular basis and pay them off at the end of the month or pay towards them, that you still have access to these payment methods, a way to protect yourself from identity theft. Shredding mail solicitations. You can now get shredders that will take the whole envelope. You don't even have to open it up and pull out the plastic fake credit card in it. You can just shred the whole thing, and I highly recommend shredding any unrequested solicitations that come in for credit cards and other things, and by being able to get a shredder, like I said, that just takes the whole envelope. You don't even have to open it and tempt yourself. Providing personal information only when necessary. And a good rule of thumb for who should I give my social security number to is to only give it out to someone whom you've called, where you've called them and you've sort of established that relationship and they are where you expected them to be and answered the phone the way you expected, whether it's your bank or some vendor or whoever it is that you're trying to do business with, and you've called them, then it's okay. But if someone calls you and offers you a deal or offers you an opportunity and wants your social security number, at that point it's a good idea to find a phone number where they are and call them back, just to make sure that they are who they say they are and they're from the company that they present themselves to be from. And regularly checking your credit report at annualcreditreport.com. When the bankruptcy legislation was changed, this website was established for individuals to be able to get free credit reports, one from each of the 3 credit agencies each year. And what's helpful about this website is that you can go back every 4 months and get one of those 3 reports. So you really can check for free throughout the year what is in your credit report. Now, something that you won't find there is your credit score. That's something that needs to be paid for. You can get your credit score from myfico.com, and if you really don't have a lot of time but you still want to check your credit report or your credit standing, you can get your credit score, and that will give you a sense if things are okay. If it's out of whack, if it's really low for some reason, even though you've been making all your payments on time, then there's a good reason to go and check your credit report and make the time to do that. Well, actually, more attention has been paid to who is checking the report. If you check your own report, it does not bring down your credit score. And when you get all of those solicitations in the mail, it's because most of them have actually pinged your credit in some small way. They've checked just a very limited amount of information. And because of that, it doesn't affect your credit score. I'm not sure exactly how much, but not very much. It's really when you are shopping for credit and you are applying. And then the organizations, the companies that you're applying to really run your credit. They want a lot of information. And what your credit score represents is your predictability as a lender. Are you going to make your minimum payments on time? That's all any lender wants to know. Are you going to make your minimum payments on time? And that's what they're checking in your credit report, is have you done it in the past? So a lot of people who actually have completely shunned debt, if they've been able to, then try to go for a car loan or a mortgage, they have a low credit score, which seems really counterintuitive because they've never had debt before in the past and there is no previous activity. So FICO is trying to work with that. Maybe you've been making your rent payments on time and other payments on time, but no, it will not hurt your credit score if you check. And also, it records that it was checked by you. Life opportunities for growth. And these are sort of the life events that we're going to get into. The opportunities that are available to you at different stages so that you can take advantage of them and at least sort of have these ideas in your mind when you're going through these periods so that you can sort of keep yourself oriented on your own financial success. So we mentioned graduation, moving in together and breaking up, growing a family, purchasing a home, and also pre-retirement. Graduation's a big one. For most people, it's the first time that they've ever been expected to be self-sufficient. A lot of people, and even that expectation has dropped considerably for a lot of people who are now moving back home. So as soon as you graduate, or actually before graduation, again, visiting annualcreditreport.com for the purpose of getting a sense of how many loans you've actually signed up for. And a lot of students will just sign what they need to in the financial aid office to be able to register for courses. And it definitely helps to just take a look, see which loans are in your name, make sure that you make a list of which loans you owe, what those monthly payments are, and what time of the month they're due so that you can continue to make those minimum payments on time. That's key to keeping up a good credit score. Automate those debt payments. Again, it's a transitional time for a lot of people, and by automating your debt payments, either having the lenders go into your checking account and pull the funds out themselves, there used to be certain discounts offered for that, or to automate your bill pay and just have that check go out once a month on a regular basis. Or if it's to a few lenders, having them go out regularly, scheduling it to get there a couple days before actually the payment is due, just to make sure that no matter what, even if you forget, you get caught up in a project, you're traveling, that payment isn't late. Because unfortunately, these lenders, especially if you're starting out in terms of your careers and your debt activity, they're paying very close attention to past behavior. So if you're newly out of school and you miss one or two payments, it's going to make lenders very jittery. And if you need to lend again to either get into graduate school or for a car or for a home, it's going to make them nervous. So by automating these payments, then you can make sure that those payments are going to get there on time and build up your credit score. Another benefit of using online bill pay for most banks, not only is it free, but that if the check doesn't get there, you don't have to pay a stop check fee, which is why it's sort of really beneficial to make sure the payment gets there a few days beforehand. For most people, if you mail off a check and it doesn't get there, you want to pay some sort of stop check fee to make sure that it doesn't get cashed by accident by someone else or maybe by the same office. And the banks who've sent out that original check will do it themselves. So just something to be aware of. To definitely, if you haven't looked into sort of online banking or automating your debt payments, now's a great time to do it. And another trend when it comes to people who are graduating is that they've been working so hard to get to graduation that as soon as it happens, people feel like they want to exhale and upgrade their lifestyles, and they've sort of, they've emerged and they're finished being a student and now they're a professional, and they start upgrading things very quickly. So one of the first things that they upgrade is a wardrobe, just especially if you're going from a college environment to a professional environment. And a lot of that is necessary, and just making sure that you do it sort of in a limited fashion. Upgrading transportation. You don't want to drive that clunky car anymore because now hopefully you're working and it seems like you have a lot of extra discretionary spending. And then also there's upgrading the apartment, especially if you've been living on campus and now you're getting kicked out now that you're graduating. And so people tend to upgrade their lifestyles quickly, even before their student loan payments kick in. So they sort of get caught because now they've made all these financial commitments, maybe a lease on a car, on an apartment, they've run up some credit card debt buying new clothes, and now suddenly, and assuming that they would have the money to pay for it, but then it's 6 months later, your grace period is ended, and now those student loan payments kick in. And at that point, they realize that they can't pay off these debts on a monthly basis the way that they thought. So just sort of taking the opportunity, every 3 or 4 months apart to make these upgrades. Just so you don't do it all at once and take on a lot of financial commitments all at once, when again, you're still trying to figure out what your new job situation is going to be and what your student loan situation is going to be. Sorry. For moving in together, and this happens throughout people's lives, and there are just some healthy habits, some things to keep in mind that help create a healthy group financial situation, just a healthy understanding between two people who are sharing expenses. And one of those things is this feeling that we each pay, that it's a 50-50 split. And it's very common in a lot of households that people just split the expenses down the line. However, when there's a big difference in what each person earns, those household expenses take a much bigger piece of that pie. So for example, a lot of people, generally when one person moves in with another, someone's lifestyle is upgraded significantly. And a lot of people do it to save on rent and other expenses, or maybe they're spending so much time together that they might as well just live together as well. But generally, one person enjoys a real lifestyle upgrade that they would not be able to afford on their own. And it's really important that if that relationship does end, it's very difficult to suffer a loss like a breakup and at the same time have to reduce your expenses as well. It's just more and more stress. So keeping in mind what you can afford versus sort of how you're living at the moment is important, just to keep some perspective as to what you might have to go back to or need to pay for in the future. So the first point here is talking about an equitable share of household expenses. So if between the household income, if it's $80,000 between two people, and one person's making 50 and one person's making 30, work that out between the two, work the ratio out between the two incomes, whatever it may be. This enables the person who's earning less to pay a proportionate share of the household expenses and still have money left to save for retirement or an emergency fund instead of their household expenses taking up their entire take-home pay. Again, a joint bank account just to pay for the household expenses. This way it's the cable bill, the rent, the utilities, and that there's a regular time that each person puts money into that account so that those expenses can be paid from the same account. And also keeping receipts of major household purchases is important. Not because you're planning on breaking up or separating, but it's important just to know what you paid for things if you want to donate it in the future, or for some people they're starting businesses, and if they want to move that asset from a personal asset to a business asset, it's helpful to keep receipts. Also, some credit cards will extend a manufacturer's warranty. So it's helpful to hold on to receipts of major purchases in case something happens to it a couple days after the warranty expires. Your credit card may actually extend that warranty. So it definitely pays to check, but keeping your receipts as well. And unfortunately, on the other side of that, there's breaking up and how to, when you're separating finances from someone, how to do that in a way where you're not spending years getting back to where you were, or just falling behind. And one of the critical things to do, as you've seen sort of along this path, is to budget. And usually when people hear the word budget, they bristle because it means I have to cut back. And a budget really is about education. And it's about knowing what your lifestyle costs. And wouldn't you want to just know what it costs so you have a sense of what you need to earn or how you need to manage it so you can still have the things you enjoy in your life? And to me, as a financial planner, a budget is like a crystal ball. Because once you have the numbers in front of you, you can play with them a little bit. And someone like me, that's fun. But it gives you the opportunity to say, well, if I took out this expense, how would my lifestyle change? And you can create sort of this idea or try to get a sense of, okay, well, if I'm not going to eat out for dinner 2 or 3 times a week, what else am I going to do? Okay, so then I'll have to go shopping a little more at the grocery store. And maybe I can have friends over, we can do some sort of potluck dinner or get together for a movie and everyone brings something. But it gives you the opportunity to look forward and see how would my lifestyle change and would I be comfortable with that change? I might travel a little less, but then again, I might sleep better at night because I know I can meet my debt payments or I know that I'm saving for the future. So budgeting and putting the numbers down on paper, and we've got a handout towards the back just to help you sort of get a sense, get a handle on where your money's going, because that's the scariest question people have, is that where is it going? I'm earning it, and I know I'm spending it. I don't feel like I'm living extravagantly. So how come I don't have anything left? And the budget answers that for you. And there's this moment with most people when they budget for the first time where it's the oh my goodness moment, where as soon as all those numbers are down on paper, people say, I had no idea I was spending that much money on this area or on this one thing. So it's really helpful to do at least once, just to get a sense of where your money's going, so you can decide if you want it to go there in the future. When it comes to breaking up, because it's so difficult to not only manage the stress of that, but also the stress of finding another apartment or having to reduce your lifestyle now that you're a single income household instead of a dual income household, and creating that budget. What is it going to take to maintain your current lifestyle? And maybe what would you be willing to live without, so that you can, manage the stress in your life? Some people go out and get second jobs. And so by doing a budget, you can determine how you can proactively change your lifestyle so that you don't have to add as much stress. And since it's been a dual income household, people are used to having dual expenses. So try to figure out what you might need just to move forward in terms of maintaining a similar lifestyle. Also just logistical things to do, which keep people from trouble in the future. Remove your name or your fair share from any joint bank accounts that you have. There's money left in them. Removing a former partner as an authorized user on a credit card. These are things that a lot of people just don't think of. And it's just important to be aware that your credit may still be influenced by someone whom you no longer really have as much of an effect on, or and are not monitoring nearly as closely as you were. And if your former partner was a beneficiary on an account, to update a beneficiary designation. And that's just a good thing in life. Whenever there's a major change, think about sort of the beneficiaries on life insurance and retirement accounts and see if you still want them there. And there are thousands of cases where an old partner, just a name on an old form, a beneficiary designation form that was filed 30 years ago, ends up with half of someone's retirement account. Because what a lot of people don't know is that that form, that beneficiary designation form, trumps a will. So a lot of people update their wills on a regular basis, but it's actually the old form that the administrator has in their filing system. That person, the way the rules stand now, will receive those funds, whether you still want them to or not. So that's something important to know.
As for removing one's name from a joint account,
Mm-hmm.
are the policies different from bank to bank, whether it has to be both persons say, yes, we both agreed to take this person's name off, or can it be initiated by one person, whether the other person likes it or not?
I would check with your bank.
It may vary from bank to bank.
And it's joint ownership, depending on how you set up the account. You may not be able to remove the other person, but you probably would be able to remove your own name.
I've heard some difficulties from people saying, it's not my debt, I can't get my name off of it, and they won't let me.
It's not your debt or it's not your account.
I think debt.
Different story.
Oh, okay.
Mm-hmm. Bank accounts, the rules are not nearly as tricky because, and it depends also if you've, run up some debt through your bank, through overdraft protection or whatever it might be. But generally with a regular checking or savings account, you can remove your own name. That's not a problem.
Well, I'm guessing that the liability that the person would have would happen from the time before they took their name off. But once you take your name off an account, whatever the other person does to bounce checks or whatever they do, you wouldn't be liable from the time you take your name off the account, I would think.
That would be a good question to ask your bank. I wouldn't think so, only because if that person then goes and bounces a check, it's going to be reported. I think that it would be reported based on the name on the account at that time. But remove your name, social security number, anything that ties you to that account. So removing that person from credit card accounts, and again, updating your beneficiary designations. Always a good thing to do whenever there's a major life change. Growing a family. Huge financial implications there, especially in this area with the high costs of housing and childcare. Anyone who's paying daycare understands just how difficult that can be. Dependent care, flexible savings accounts go only so far. Again, preparing a budget, and especially when those expenses jump, especially when you have a child or another child, taking a look at how you can try to stagger the expenses. A lot of things happen all at once. As soon as a lot of people find out that they're expecting a child, the first thing they're told to do is go out and spend. That you need to buy a whole nursery full of furniture. They suddenly need to go out and buy a house, and that there's a current trend where people feel that they must buy a house before they start a family, that it's a part of establishing a foundation for the family. And what a lot of families end up doing is they sort of paint themselves into a financial corner because they've made one huge financial commitment within a short amount of time of making another huge financial commitment, which is having that child. So, so because of the housing boom, there was this message sent out that you really had to buy a house to have a stable family, or to bring that baby home to a large house. When in fact a lot of people who did that found that they really weren't financially prepared for it. They hadn't really planned for it. So by taking a look at your current expenses and seeing that if you are considering daycare, or if one parent is considering cutting back on some hours, or some sort of combination, how that's going to affect your lifestyle, how that's going to affect your housing costs, and how much, sort of where can you make some simple changes to maybe reduce some of the additional stress on the family financially. And again, the budget breaks down the numbers so that you can decide, well, so that you can cut out exactly what you need to and not anything more. Also, when it comes to education savings, just parents, out of the desire to support their children and to help their children, choose to fund education savings before their retirement accounts. And it's a struggle because parents love their kids and they want to do everything that they can for them. That, and the best thing that you can do for your child from a financial planning perspective, is to fund your retirement first. And the reason for that is that what we're seeing now with the sandwich generation, if anyone's familiar with the term, is that parents who are trying to, I should say grandparents, who now need some sort of long-term care, or they need help, whether it's time or financial, that was this sort of unspoken expectation that their children would step in to help them. Only the children can't really afford to, because they're trying to fund their own retirements, they're trying to fund the grandchildren's education expenses. It really puts a lot of strain on those children who were once newborns and now, they're raising their own families. So the best thing financial planning-wise you can do for your child is to make sure that you're in a stable financial place yourself. Getting the long-term care insurance if you feel that you need it, building up your savings, making sure you've got the right life insurance policies in place. Otherwise, although the parents may just assume that the children will be able to step in time-wise, financially, and help them as they age, with the higher costs that we see these days, that might not be the case. So sort of a compromise is to split your education funding. Let's say there's $100 a month that you find that's important to you to put towards education savings. Put half in your Roth IRA if you qualify, maybe half in a 529 plan. Anyone who lives in Maryland, Maryland State offers a state tax deduction for 529 contributions. And this gives you flexibility, because also college 18 years from now might look very different than the way it looks now, especially with colleges putting curriculum on the websites and over the web, and maybe college will be a series of internships and online classes, who knows. And by splitting up your funding between a couple of different options, what you're doing is creating opportunities. So for example, let's say your child gets a scholarship and doesn't need the money in the 529 plan. Then, or you've now got that money in your Roth IRA that you can use for retirement. Also, like we said with the Roth IRA, is that you can pull your contributions out, your own contributions, not the growth or the interest, but your own contributions out at any time. So let's say if you've spent the last 20 years putting $100 a month, into this Roth IRA, you can then pull that money out without any taxes or penalties. Also, because Roth IRAs offer the option to pull out some interest that you can for higher education expenses. You can actually use the earnings and the interest. And you won't pay a penalty if you're under age 59 and a half, but you will pay income tax. So in that case, using that dual approach, first funding your retirement either through your employer-sponsored retirement plan or a combination of that in your Roth IRA, and putting some money in a 529, because you really don't know what those expenses are going to be. And this way, if you don't need the money for higher education costs, you can also use it for your retirement.
Can you tell me how either or both the Roth IRA and 529 affect when you apply for like a Parent Plus loan? Or do they, like if they see that you, the financial aid, if they see that there's money in the 529, will they give you less money for the Parent Plus loan, which is a form of financial aid? It's just the parent takes it out so the student?
Do you use the FAFSA form to determine?
Yeah.
Okay. I just looked into this recently for a client. FAFSA, the standard form used to qualify for federal student aid, for student loans, does not take retirement accounts of the parents into consideration, and it doesn't also include 529s.
It does or does not?
No. However, the schools themselves, if they know those 529s exist and that those Roth IRAs exist in the child's name, that they will expect the child to cash them out to pay their portion of education expenses. So something that a lot of parents do will try to put money aside in the child's name. For some people, it's an estate planning tool. For others, it's just they want to give to their child, so they create, a custodian account where they can put the money away in the child's name, and the child goes to college. The way a lot of financial aid offices think is that they consider college to be that child's primary priority, and that if they have any assets, those assets should go towards their college education. So although I believe the formula for parents' assets, not including retirement assets, is like 5%. They expect the parents to pay maybe 5% of the cost. They expect the child to pay somewhere around 30% to 35% of the cost. So if there's money in your child's name, the college will ask for it. If it's in a Roth IRA, if they worked when they were younger, but as I believe as it stands now, not in a 529. FAFSA won't ask, but the college will.
But a 529, you can say you designate it to a child, but the parent is getting it out. So whose name does that end up being under?
If the child is the beneficiary on the 529, then it is intended for them. And you can change the beneficiary once a year if you have other children. It's important to ask the school. FAFSA, as I understand the way the rules stand now, is that it doesn't take 529 plans into account. It's not considered the assets of the child. But the schools will ask, and the schools will take it into account their own formulas as to how much they think the child will pay, and that might affect any scholarships or financial aid that the school is providing.
Okay. Well, there's need financial aid and there's non-need financial aid. And so I don't know if it affects only the need part.
I'd ask the school, because now that schools know that FAFSA's not going to take it into account, and they know that the money's there, they want the parents to pay it. They've saved for it. This is what they've saved for. There's money there for college that they can use tax-free. And the schools want the parents to use that money. So it's important to ask the schools themselves as to what they're going to consider assets available to pay for the college expenses. So again, just using that, thinking about approaching the idea of using some of your education savings, put some of it into a retirement account that you can tap later if you need to, and some into a specific education account.
I just wanted to provide something. My wife put this very succinctly. She said basically, you can always pay for education. You can always borrow.
Yes.
You can't never borrow to pay for your retirement.
Absolutely. That there is, I was in a LifeWorks presentation, someone said, well, should I borrow from my home or from my retirement? And that hurts, a question like that. But it was necessary. And I answered to borrow from the home, because you can replace a home, but you can't replace a retirement. No one is going to lend you money to finance your retirement. And the earlier you start and the more you protect those retirement savings, the more opportunities that you'll have to extend to your children when they're older and when they're really going to need you. So making sure that you're in a stable place for them to come home to if they need to throughout these different life events. And being able to provide the flexibility, maybe the time, to help them with a growing family, or a little extra money if they need it. By putting yourself in a stable place, you're able to help them, versus they're in an unstable place and you're in an unstable place and you need them and they don't have anything more to give. So no one wants to be in that situation. Again, review your beneficiary statements. Make sure that if you're naming your children individually, that that if there are any new children, they're all on there. Increasing life insurance to help cover for, especially if you're young, term insurance that would cover you long enough to get them through college. Just to make sure that those future child care and education expenses are covered. Some people just assume that they only need an amount for their mortgage or a certain multiple of their income, but it really pays to break down what you think your family is going to need and create and determine how much life insurance you need based on that amount. And create a will to establish guardianship for the child or the children, something that's very important. And making sure that the people who you would like to raise the children have also the funds to do it. So, and working with your life insurance company in terms of those beneficiary designations to see how you can make sure that there's funds available for whomever will be taking your children, and also so that the children can inherit themselves. It gets a little tricky with inheriting, for children inheriting things if they're minors. So just, when you get that beneficiary designation form, call the number, tell them what you're trying to do, and they'll tell you how to correctly make the beneficiary designations.
How important is it for life insurance to do it if you don't have a family yet, but you're just getting older? Like,
So, I get that question a lot of people who don't have a family now but would like to have a family, and they want to lock in a life insurance policy while they're young. And you can sort of use averages based on what it would cost to raise a family, in the area where you'd like to live. And just, locking it in, and then you can always decide if you want to stop, paying on it or reduce the amount. So just making sure that, again, the people that you would like to be taking care of your children are set on the beneficiary designation form to receive those funds, whether it's just maybe the interest that would be generated from the life insurance settlement, things like that. But definitely pay close attention, again, to those beneficiary designation forms. Purchasing a home. This was a lot more fun a few years ago. Well, now I'm swamped. Okay. Well, we've got the presentations here. Great. Purchasing a home. More than ever, when it comes to purchasing a home, again, budgeting is extremely helpful. Thank you. I don't know how I did that. But, two things that need to happen right away, even if you're just thinking about purchasing a home. When shopping for a home, the first thing to do is shop for a mortgage. Whether you've got a credit union that you work closely with, or a mortgage broker or a friend who was very happy with their mortgage broker, first thing you do is find out what is your new monthly payment going to be. Let's say you're looking around, you decided that you feel safe enough about your future income that you'd like to purchase something that's important to you. The first question is, what's it going to cost me? That's the first financial planning question, is how are my housing expenses going to change? And a lot of people, when they purchase a home, they just look at the mortgage, what that mortgage payment's going to be. And for anyone who has purchased a home, they know that those expenses are actually much, much higher. If you've never paid property taxes before, you're paying that. If you've never paid homeowners insurance before, you're paying that. There are utilities. There's now a house to furnish. And people feel funny not having any furniture in their home for several months, so they go and they buy it on credit. If there are any improvements that need to happen in the home, you can't just call up the landlord or the property management company anymore, that you have to pay for that plumber to come out. So there are a lot of additional expenses that go into owning a home. And to make sure that you don't get in over your head, making sure that you've got a budget in place that compares sort of what you're paying now and what you expect to pay as a homeowner, based on the home values in the area that you're looking at. And again, seeing how that's going to affect your lifestyle. Just because people buy a home doesn't mean they don't want to travel anymore. It doesn't mean they don't want to eat out anymore or do the things that they enjoyed doing before they were homeowners. However, they were qualifying for these very high mortgages that required all their income. So what happened was they committed all their income, even though there were still these other lifestyle things that they needed that they hadn't planned on giving up. So definitely comparing your expenses. And a lot of people find that as much as they would like to own a property, they might need to go for a smaller property, maybe starting with a condo instead of a house. And even landscaping, things like that. Asking friends or people that you know that own a home in that area and finding out sort of what the expenses are in terms of utilities and things like that. So the first is budgeting, making sure that you have a sense, again, that crystal ball as to how your lifestyle is going to change with these new expenses. Also, if there are two people purchasing a home together, also if it's just one person, checking your credit is extremely important before you go looking for a house. Many people go looking at the houses, they go shopping for a house before they shop for a mortgage. And when two people then sit down, with a mortgage broker or with a bank to sit down and get their mortgage, the last thing that you want is for, someone's low credit score to keep you from getting that. And a lot of people don't even know what their credit scores are. But you can avoid a very stressful situation by checking your credit score before you sit down and actually start applying for mortgages. Because if you apply for a mortgage with another person, that sort of, if you're turned down, that person is going to find out why. So what a lot of people like to do is maybe, 5 or 6 months before they start looking for a home, or just to do this, it's a healthy thing to do anyway, is take a look at your credit report, your credit score, and see how you can improve it so that you can qualify for the best rates. Nowadays, banks are only lending, 80 to 90% of the value of the home, which means you need to have 10 or 20% to put down. And in this area, that's a lot of money. So definitely making sure that your credit score is high enough to qualify for the best rates that you can, and that it's just not a surprise when you sit down at that desk with the other person, and that it's going to come up on that screen when the lender checks your credit.
What is considered a good credit score?
That's changed recently. 720 and above. Yeah, and definitely into the 700s. Before it was a little lower. Now banks are more skittish, so that concept of what's a prime rate. But definitely in the 700s. Some people tell you 750. And it doesn't take that long to improve a credit score because lenders want to see what's happening in your life now. They understand that things change over time. Employment situations change. Family situations change. So if you start to improve your finances, paying your bills on time, just making sure that everything's in place, a good 4 or 5 months before you apply for that loan, you can then again show that you've made a consistent effort to being a good borrower, so that you can show that history, as we discussed before, so they can assume that you'll continue to be that predictable borrower, which is what they're looking for. Something else that I see a lot of now is for single people who were able to purchase homes themselves with one income. They actually have estate planning issues, which usually a lot of issues don't come up until they're older, which is that because they're single and they own a property, properties don't pass through to heirs the same way that bank accounts and retirement accounts do. That it's something that needs to go into a will or into a trust. So for example, if you are single and you own a property and you want that property to be inherited by someone, and you put that in a will, then there's a process for that will to be executed, and it's going to take some time for that property to be given to your heir. And meanwhile, there are mortgage payments that have to be paid. You don't want the bank to foreclose on the property right when you want it to go to that person. So making sure when we're talking about life insurance, first of all, making sure that if that is the case, that you have a will, or that you've checked the laws of the state that you live in to make sure, to see if they will automatically give it to a parent or a sibling. They usually break it up. And determining sort of who would receive that property, and making sure that there's enough life insurance going to that heir as a beneficiary to cover those mortgage payments, to make sure that home isn't foreclosed upon before they can get it. And pre-retirement, again, one of the things that, there are two things that actually, yeah, please. Mm-hmm.
What would you advise for people who are looking to purchase a home jointly in terms of, securing their finances, making sure if they ever have to move out for whatever reason, then what documents would you make sure that you can complete?
Are these two people married?
No.
There are a lot of legal issues to consider when two people who are not married are purchasing a home together. because there are tax implications. Even though you're sharing a home with someone, the IRS considers you two unrelated parties. People who are married, and if one person, say, passes away, the other person can basically inherit the property without any tax problems at all. It's the unlimited marital deduction that spouses can give each other things. It's not considered a taxable gift. Inheritances, gift taxes, things like that are not a problem. When they're unmarried, they're considered unrelated parties, which means that you can run into taxes by going into this together, especially if one person has a lot more cash to put into the deal than another. So if you put down the down payment and you're expecting the other person to kick in income for the mortgage, and their name is also on the property, it can be considered a gift, because it's like you're giving them a gift of the money that's going into the down payment. So definitely, I would say talk to your tax advisor if you have one. If you don't, go get one, because it can be a bit tricky, and you want to make sure that there are no ugly surprises down the road. As we mentioned with budgeting before, again, a huge time where a lot of people run into trouble is when they want to retire and they've put in their time and they're ready to step back a little bit, and they're not yet sure what they want to do, and they're not yet sure what it's going to cost, but they know that they don't want to keep doing what they're doing now. And when that happens, they run into a couple of specific problems. The first is that they use up valuable resources while they're trying to figure out what they want to do. And it can take some time to figure out what they want to do. And the expenses change considerably also if someone is considering sort of working part-time first and sort of easing into retirement a bit instead of going cold turkey. So again, I'm going to keep recommending a budget. That change in lifestyle, that crystal ball, once I no longer have this regular income, or I'm starting to live off my savings, or I have an annuity, what is my new income going to be? At what point down my budget am I not going to have any money left for the expenses that I have? And how soon, and if I want to keep that lifestyle, maybe I need to continue to work part-time. Or maybe I'm willing to let go of those expenses so I don't have to punch a clock anymore. But the budget will show you sort of where you can make those changes to help you clarify your choices. And again, that first year, especially being able to maintain health coverage and things like that, a lot of people will start with part-time. Federal government's trying to bring people back in to help maintain the workforce. So definitely just doing a separate budget for that first year, and then maybe moving forward, just because it's a transition year and you want to make sure that you don't spend any more than you have to, and that you're keeping an eye on sort of the long term. This is something that affected a lot of people this year because there was such a drastic reduction in values in the stock market, is that any money that you expect to spend really within the next 1 to 3 years, but it's hard for people to put 3 years of living expenses in cash, should not be invested in the stock market. The stock market is a long-term game. And if you need the funds, especially within the next 12 months, it really should be sitting in cash, because that way you know that the money that you put in there will not change, the value of it won't change, that it's going to be sitting there waiting for you to spend over the next year as you intend to. So any funds that you expect to spend, especially within the next year, preferably 3 years, to have in a very stable type of account, whether it's sold and it's sitting in cash, or you have CDs, but just something that will preserve the value of it, and it's not invested in the stock market, whose value goes up and down over time. Again, reviewing insurance policies and beneficiary statements. If you were holding life insurance, keeping it going to make sure that your family was covered while there were education expenses, and those education expenses are now over, maybe you can reduce your life insurance a little bit. It's also a good time to look at some permanent life insurance, otherwise known as whole life insurance, just that there's something there that you can be sure will be there, that you won't outlive. And just taking a look, like I said, a lot of people don't look at beneficiary designations that often. So again, when there's a major life change, just making sure that, that your beneficiary designations are up to date. And again, retiring with a plan, taking 3 or 4 years to figure out what you want to do in retirement can sap a lot of resources right up front, which has a really large effect on the long-term earnings of a retirement portfolio. So, so retire with a plan. Just try to ease into it, see what works. A lot of people who think they're going to be happy doing one thing start doing it and realize that it's not what they had in mind. So just being flexible and considering that you might want something else than you originally, just not punching a clock anymore, not required to do anything anymore, that it is something that will stick and that it's something that you can ease into and something you can sustain in the long run. Just some helpful resources. These are some of the just some things that I've done. There's a podcast by Genworth Financial for new parents, particularly talking about insurance. Personal finance for young federal employees through federalnewsradio.com. And also there was a budgeting teleconference through the Department of Labor, the Women's Bureau, just on, again, on helpful tips on staying ahead of your expenses. If anyone has any questions, please feel free to ask. Yes?
My main question is, let's say you have like a certain amount of extra money after everything is said and done, after you've budgeted properly, but you have, different things that you need to address, let's say, credit card debt and Roth IRA, emergency funds. Is there like a special formula that you use? Because if you put it all towards credit card debt and you don't have emergency funds, it feels ridiculous to put some in emergency fund when you're paying interest. So is there like a special formula that you recommend?
There's definitely a savings priorities list that I recommend. Let me ask a quick question first. You said if having money sort of left over at the end of the month or to put towards something, are you able to meet your minimum payments on your debts? Okay, so it's after the minimum payment. Definitely, the first thing to do is to save 3 to 6 months of debt payments. A lot of common advice is to save 3 to 6 months of living expenses, and that can be a lot of money. But by first saving 3 to 6 months of debt payments, if there's a period of short-term unemployment or there's some sort of medical event and you run out of sick leave and annual leave or your short-term disability doesn't kick in, by having 3 to 6 months of debt payments, you can keep your credit score high while you figure something else out. This way a short-term setback doesn't affect you for the long run. Credit reports go back 7 years. That information will haunt you for 7 years if you miss 1 or 2 payments on a student loan or a car loan. So definitely start there. Once you're there, see if also there's any, and that money should also go into like the money market account, the emergency fund. At that point, I would definitely recommend splitting it between your highest credit card rate, interest rate, whatever balance you have on that plan. Even if it's a smaller balance than you have on another card, the interest rate is very important. That and your retirement savings. Because what a lot of people find is that they'll either put all their money into their debt to pay off their debt, and then something happens and they don't have any extra cash for an emergency, and they have to go to their credit cards. And a lot of credit lines have been shut down, and it affects their credit score. And if you have your own cash, you at least have that choice. Do I want to spend my own money, or do I want to spend someone else's money with a credit card? And you do have that option. So first, the 3 to 6 months of debt payments. Your budget will show you exactly how much you're spending in debt payments. And then after that, splitting it between paying down debt and saving for retirement. And in terms of saving for retirement, if your employer offers a match, start there. Because I used to think that first you should start in a Roth IRA, and then when you vest, that's when you should start investing in your 401k or 403b. But the truth is that because you don't pay any trading costs to invest through your 401k, your 403b, your TSP, it actually, your money goes farther that way. So especially if you're just getting off the ground and learning, an employer-sponsored retirement account is the best way to do that. Well, I do want to bring your attention to some handouts towards the back. This financial management plan is really helpful because it puts everything down on one page. It's towards the back. You've got your income, a myriad of different expense categories, creditors, outstanding debts. It's really helpful to have everything on one page. My favorite financial tool is an Excel spreadsheet, where I have something just like this at home, where I've got everything on one page in front of me, and I can just see how it all works together to see if I'm moving in the direction that I want to be moving in. So that's something that I highly recommend. There's also some identity theft protection tips beyond shredding. Phone numbers for credit agencies and how to contact them. Oh, something to be advised, if you go to annualcreditreport.com and you put in the wrong answer, you'll have to do everything by mail. It's good because you can make some progress over the phone, but they're very protective of your credit, which is good. However, don't guess when you're on the website because it could set you back a few weeks in terms of trying to get your credit information. And also identifying financial goals. It's important to know what your short-term, intermediate, and long-term goals are because the money that you're going to put away for them should be in certain accounts. Again, we said really short-term money should not be invested in stocks and bonds. You know, a money market account, savings account, high-yield savings account, because you expect to need it soon, you need to make sure that the value of it doesn't change. Intermediate goals, you know, maybe CDs, something that earns you a little more interest. But unless it's retirement money or money you're really not going to need for like 10 years, only that money should really be in the stock market because as we've seen, the market can change drastically year to year. I'm still a big believer that the stock sort of using index funds to invest for the long term is the best way to go. However, any money that you're going to need between now and 10 years from now should not be invested in stocks, just to be aware of. Thank you for attending. It's been fun, and if you have any questions, please ask.
For getting the credit report online,